Right, good morning everyone, and welcome to the Pinnacle Listed Learnings webinar series. My name is Chris Mayer. Thank you for the early start. 9 a.m. is a fresh start for a webinar, but we do have a guest speaker today from Toronto, and it's 7 p.m. his time, so we didn't want to interfere too much with his evening. So good evening, Andres. You can see is the other participant there on video. Pinnacle is an active participant in the active ETF industry. And so what's happening internationally is very important for us. Today we have two topics that Andres will cover. He's a bit of a guru on both. The first is Canada. Canada being the largest active ETF market globally, and certainly the one that has the longest history. So we think Australia in particular can learn a little bit about what has happened in the Canadian market and therefore what it might mean for the Australian market. And the US market is also interesting because very recently they have allowed active ETFs for the very first time. And given the size of that ETF market, hearing about what's going on there, I think also has some parallels for what might happen in the Australian active ETF market. So we've got about a 15 to 20 minute presentation that we'll run through. Then we'll do a Q&A session with listeners on the call. For those of you who aren't familiar with Zoom, if you do want to ask a question, please just type it into the Q&A box at the bottom of your screen. All right, so let's dive into it. The first thing I will say is the reason why we thought the US and Canada were important markets to look at, just to set the scene, is if you look at this chart, which I've actually nicked from the ASX, Canada, the US, and Australia are three of the world's top 5 savings markets globally. They have very large pools of capital. As you can see on this slide, on the far left-hand side is the US, obviously the biggest pension market in the world. Next to it is Canada at about 1.6 trillion US dollars. And actually larger than that market is Australia. So you can see very large savings pools. And so I think it's fair to say very sophisticated investor base. All three markets allow active ETFs. The regulator and the exchanges in all three markets now allow active ETFs. And so the size of those savings pools as well as the regulatory backdrop means all three markets, I think, have very close sort of correlations between what trends and developments might happen in each of those markets. If you look at the actual, the next slide, which is the stock market. Sorry, I'm just waiting to see how this comes up. Having a bit of a hassle trying to move these slides. There we go. Okay, so on the x-axis is the market capitalization of the domestic market relative to the size of the economy, as shown by the gross domestic product of that country. So that's a bit of a feel for, I would say, the equity culture of these three markets. And so you can see Canada, the US, and Australia all towards the right-hand side of that x-axis, which really means a very active equity culture. And then on that y-axis is the size of the regulated asset management industry, so that let's call it the fund industry, relative again to the size of each country's economy. And so again, Canada, US, Australia, the three markets we're talking about today, very much towards the top of the chart, showing that it's got a very sophisticated fund management industry in each of those three markets. So again, high equity culture, high fund or high penetration of the fund industry means that active ETFs, which is really a combination of stock market, fund industry, means that all three markets, I think, are very well poised to have high penetration of active ETFs. And then finally on this slide 4, what you can see is the development of the ETF market in each of those three countries. So starting with the US, in the blue bar, you can see that the US market has the highest level of penetration of ETFs relative to the size of the fund industry at 16.5%. That's the size of the ETF assets relative to the size of the fund industry's assets. But a very low penetration of active ETFs, as you can see on the green bar, 3.9%, is the size of the ETF assets active ETF assets relative to the size of the total ETF industry in the US. Canada, pretty good penetration of ETFs, 10%, very high penetration of active ETFs, as you can see, which is exactly why we wanted Andres to cover that market with us today. And then Australia, which is most relevant for us, is very low penetration of ETFs, 2%, a fraction of where the US and Canadian markets are, and a reasonable penetration of active ETFs as a percentage of total ETF fund industry. All right, so I think with that setting the scene, I'm going to hand over to Andres, and we're going to start with Canada. So Andres, over to you.
Thank you, Chris, for having me. Can you hear me well? Just want to confirm that and see me well. All good? Great. And good afternoon to everybody listening in Australia. I'm just going to go through some of these slides and tell a little bit about the story of Canada, how we grew, and also how we've gotten to this place where we are right now, where actively managed ETFs have proliferated in our industry so much. So Canada, obviously considerably smaller market than the US market, but we now have about 973 ETFs in Canada, which is a pretty substantial number. If you put it in comparison to the US market, which is 2,300 ETFs, give or take, it's quite a bit of ETFs given our size, given our market. Generally, the Canadian market, we always try to compare it as being, 1/10 of the US market. So obviously, when it comes to number of ETFs, it's an outsized number. A couple things that are interesting to note from this slide is that, call it a third of ETFs in Canada are fixed income ETFs, which is not necessarily the case across the world. But I'll get into more details later on this. One little interesting tidbit that I always like to say for those of you that don't reside here in Canada is that many people don't know that the first ETF ever created was done here in Toronto. It was the TIPS, basically, which it was a index participation units for the Toronto Stock Exchange 35 index, which was the first ETF in the world. And actually, the first fixed income ETF was also done here in Canada. So if you look in Wikipedia and many other sites, you'll generally get that the first fixed income ETF was launched in 2002 in the US, but the actual first one was launched by Barclays or BGI in Canada in 2000. So that's where we've seen quite a bit of the growth and a lot of the momentum in Canada. So we have about 14% growth in the last 5 years, which is a pretty substantial number. We currently have about, call it 39 providers in Canada. We have seen some consolidation over the years, but that's it continues to grow. It's actually not 973, it's 982 right now. Obviously, it grows by the minute, and we have 40 providers now. You can move to the next slide. In terms of AUM, we've seen a pretty substantial growth in AUM over the years. Even during COVID, it's grown substantially. I think this year we already have $18 billion worth of inflows year to date. So it's a significant number, and it's kind of staved off or short off some of the losses, obviously, that some of these funds have enjoyed or have had over the last few months of volatility. And this is what we're really here to talk about today is actively managed funds. And what you can see here in this breakdown is that, call it 20% of ETFs in Canada are actively managed. We call it discretionary funds, but it's the same idea as actively managed funds. And this is where a lot of the growth in Canada is. If you look at the real picture and compare indexing versus discretionary, a lot of the growth comes in the discretionary bucket. Look, if you step back a couple of years ago, this bucket was considerably smaller and it has grown substantially. Obviously, the indexing world is much bigger because those were the original ETFs, and you have a lot of the mega cap ETFs in Canada there too. So if we move on to the next slide, let us talk a little bit about how we got to this point here in Canada. So for a long time, Canada was overwhelmed in as to what the rules exactly were when it comes to disclosure. But in 2016, our local regulator, the OSC, put out a note basically telling the entire street that it is okay to disclose for ETF providers to disclose their holdings on a quarterly basis. So ETFs and mutual funds in Canada are regulated under the same regime. So ETFs basically can operate under the same rules as mutual funds, which means that they can disclose, if they so will, the holdings to the public or to the market makers on a quarterly basis. This has, of course, allowed the active manager to come into the ETF industry because they don't have to disclose their secret sauce, their expertise to the street. So that has allowed actively managed ETFs to grow substantially in Canada. As a result, we have now about, call it 30% of Canadian listed ETFs that are non-transparent. And just to be clear, non-transparency means that the holdings are not disclosed, and active means that the manager has an active mandate. So there's a bit of a difference there, but obviously high correlation. In Canada specifically, there's what I would call 4 degrees of disclosure in the ETF industry. We have full transparency, which is exactly what we have in the US. They sit on that side of the spectrum where every single ETF that's launched needs to provide disclosure of their holdings to both the market makers and the public. Well, this is as of recently. Obviously, there's been developments in that market, and we're going to talk about that. Then you have in Canada, you have partial disclosure, which is very, very popular too in Canada, which basically means that you don't disclose to the public on a daily basis, but you disclose to your market makers. And I would say that, so obviously 30% I mentioned are non-transparent. That's the 2 buckets that I would put in, that I would allocate to selective and fully non-transparent. So the next 2 ones I'm going to talk about. This is selective disclosure is the one where the market maker basically does not disclose to the public and only selectively discloses to the market makers. And the last but not least is fully non-transparent, which means that the ETF provider does not disclose to the public on a daily basis and also does not disclose the holdings to the market makers on a daily basis. So we have the full spectrum in Canada. The fully non-transparent is a very small part of the ETF market in Canada, but we do have a selective disclosure. We only have 1 provider that does that really. And fully transparent and partial disclosure are very popular. As I meant, obviously the last 3 are not transparent towards the public.
Just for, maybe for listeners' benefits in Australia, this is sounds like a reasonably technical area, but it's actually quite simple. Mostly passive ETF managers that track a benchmark are very happy to disclose their portfolio holdings daily, and so they go the fully transparent route. But as Andres said, active managers tend to prefer to keep some of their secret sauce, as he calls it, private, and so only want to disclose their holdings quarterly. And that's the fully non-transparent version of what Andreas was talking about. In Australia, those are really the only 2 options available. The middle 2, where there's sort of this partial disclosure to some market participants, but not to the public, the regulator has not really been comfortable with. And so in Australia, we really are, you either disclosing your portfolio completely, the fully transparent version, or you're going for the non-transparent version, where you only disclose your portfolio quarterly to the market. So on the next slide, Andres, yep, off we go.
Yep, that's fine. What I will say is that, and we can get into this later on, but all these markets work in different ways. They do operate, and we can make markets in all the different ones that I explained there. It just depends on what the client wants and what the ETF provider is looking for. But as a market maker, which TD is a market maker for ETFs in Canada, we're able to do all of those. In terms of the evolution of actively managed ETFs in Canada, so as you can see in the chart on the left side, the number of actively managed funds has grown substantially. So we're at, I think it's 385 ETFs right now, which is a good chunk of the market. But the AUM has grown quite steadily, especially last year. It grew massively, and we'll touch on which area specifically grew. But this is an area that where we believe is the future of the industry in Canada. Obviously, you have, as I mentioned earlier, every country will have its mega cap index fund, right? You know, the S&P 500 in the US. Here we have XIU from iShares, which tracks the S&P TSX 60 index, for example. These are mega cap ETFs that have been there for a long time and will be there, but you can't really create another 60 or another S&P 500 as easily, let's say. So we think that a lot of the growth is in active management, where what we're basically seeing is the transition from the mutual fund active manager coming into the ETF industry. With these regulations, when we opened the door, we actually opened the door to that manager who generally didn't want to come into ETFs because they didn't want to disclose anything. Now they can. So we're seeing a flurry of ETFs launched every week, basically, that we have to make markets on. And as you can see here, the growth has been pretty substantial at 38% over the last few years. So it's pretty substantial number and pretty impressive number, in my opinion.
Yeah, and I think, you know, I've inserted a few numbers there for the Australian market on the left-hand side, just to indicate how nascent the active ETF industry is in Australia. We have 42 active ETF listed on the exchanges in Australia, you know, compared to the nearly 400 in Canada. And remember, they're very similar sized savings markets or fund management markets. So it's obviously much smaller here than in a developed market like Canada. And if you think 42 funds, there's more than 3,000 actively managed funds. And so there's a long way to go, really, to see more active ETF issuance in Canada. And then on the right-hand side, very similar picture. There's $5 billion in active ETFs in Australia, but frankly, a big chunk of that is Magellan. And so if you strip out Magellan, you know, the industry is even smaller. And so we feel very confident that the penetration of both the number of funds and the assets in the Australian active ETF market should grow, as the Canadian example has shown.
And just to add to that point, that if you are an ETF manager or ETF provider here in Canada, and you are a large asset manager, which has, you know, you have closed-end funds, mutual funds, or whatever it is, generally what's happening now is that a fund will be offered in different classes, right? So you will have the mutual fund version in all of its series, and you have the ETF version for different client bases. So when an ETF provider comes in, they'll say, here is my fund in various classes. You pick one, basically. Which is why, once again, we're going to see more and more ETFs in Canada as ETFs catch up to the mutual fund industry. In terms of the asset breakdown, this is where it gets really interesting. Look, as I mentioned earlier, 42 billion or so is in actively managed strategies, which is obviously the larger indexing. When it comes to the asset class mix, 44% of ETFs that are active in Canada are in fixed income, while they're only really a third of the ETFs in Canada. So they're really punching above their weight when it comes to actively managed funds. And you can see in the indexing world, they're considerably less. They're about 31% of the indexed world when it comes to fixed income ETFs. So a lot of the growth has, you know, been driven in both fixed income ETFs and the other, you know, it's only 5% there, but it's growing really fast, which is asset allocation ETFs, which we can touch on later on. But yeah, fixed income, actively managed fixed income ETFs have seen quite a bit of the growth in the industry. And that's really where we've made a lot of our expertise and where we are spending a lot of time. Like, I'll give you just an anecdote. Our ETF desk, we have 6 traders on our desk. Our head of our desk on the ETF side, on the trading side, used to be a bond trader. And we basically are our fixed income book is basically annexed to the bond desk on our dealer. So we have a very strong connectivity there, and that we think is essential to the growth of the industry and being able to service our clients. I think in terms of where have we seen the growth? Well, I already mentioned a couple of these, but active fixed income has been a area of growth for Canada. We have, let's say, the PIMCOs of this world coming into Canada to launch ETFs without disclosing their secret sauce. And really, in reality, what happens is the areas that are popular are the areas that are complicated. Where the advisor or the retail investor or the institution doesn't have an expertise in, and there's a large asset manager who has that expertise, and they offer it in an actively managed fund. And that's where we've seen quite a bit of growth. If you look at the chart on the right, you can see that obviously equity ETFs have still grown in assets, but we continue to see parabolic growth in fixed income ETFs. An area that is quite unique to Canada, well, I say it's unique, but I know in other places there is exposure to these. I think they're called, we were talking about this, they're called hybrids. In Australia, in Canada, they're called preferred shares. This is an area that has gathered quite a bit of momentum in the actively managed front. And this is simply because the advisor or also the institutional manager does not want to manage this portfolio, and they give it to somebody to manage. So that's an area that's we've seen quite a bit of growth. In equity specifically, what you're getting is your traditional value fund or fundamental traditional mutual fund manager coming into the equity space that has a name and is launching a fund, let's say. Other areas that are really, really popular are asset allocation ETFs. And this is interesting because this has caught on in Canada quite substantially, especially in the retail side, but not in the US. So asset allocation ETFs you're basically your one-stop shop for a exposure to a balanced portfolio, a moderate portfolio, an aggressive portfolio, right? So your 60-40, 70-30 type of thing. Vanguard in Canada has done a great job of launching these, and there's several $1 billion of these ETFs in Canada in their funds, but there are many other ETF providers are launching theirs. So this is an area that's definitely proliferated in Canada. The other one in liquid alt ETFs, and without getting into too much detail, liquid alts are hedge fund-like strategies. As of this year in Canada, sorry, as of last year in Canada, you're allowed, or mutual funds in ETFs are allowed to offer more hedge fund-like strategies, and these have become more and more popular in Canada. And obviously, these are for the most part actively managed strategies. And we're seeing quite a bit of growth there. It's still very early. Obviously, the industry has been there for a long time as a hedge fund product, but now in ETFs, it's early days, but it is growing. And last but not least, what also fits into the equity space is real assets, which have grown quite a bit. In terms of who's buying, the main buyer by country mile is the advisors. They want to offlay some of their management of funds to somebody else, and that's the way they do it, by buying ETFs and by buying actively managed ETFs. Direct investing, they do invest in actively managed funds, but it's more of an awareness. It takes a bit of time to get to know these products. At the end of the day, they do invest in mutual funds already, but they don't know that actively managed ETFs exist as much as they know that ETFs exist. In terms of the institutional buyer, this is an area that's considerably grown over the last few years. Basically, what we have here is we have a manager that has expertise in a variety of things, but they don't have expertise in press or global fixed income, and they'll use the ETF for that exposure. And this area has grown massively over the last few years. I'm not sure how we're doing on time, but in terms of fees, generally speaking, actively managed ETFs, the fees have actually held on quite well, in that we have a lot of new entrants. The more entrants you have, then the average fee kind of, remains higher or stable. So we generally see it stable compared to index products. But generally speaking, if you have a new fund that doesn't have it's not an ETF class of an existing fund, you will get the lower fee than the mutual fund version. But if it is an existing, if it is an ETF class of an existing fund, generally it's priced in line with the mutual fund. In terms of trading environment, I don't need to necessarily get into too much detail, but there is a significant variance at times between the traditionally fully disclosed product and the spread of that product versus the fully non-transparent product. Just to be clear, in Canada, a lot of these products that are fully non-transparent that we talked about are mostly fixed income products because they don't move as much and the volatility is lower. While a lot of the products that are launching in the US are equity products. So there is a degree of spread differential between the different disclosure levels, and just depends on the volatility of the product and what we see.
Thanks, Andres. That's first I've heard of Canuck experience. For those of you like me who didn't know what that means, that's colloquialism for Canadian experience. So
that's correct. There's even Vancouver has a hockey team, and their team is called the Vancouver Canucks.
The Canucks, okay. I think we should move on to the US market. We've only got one slide and then we'll get into Q&A. The reason why the US market is relevant for this discussion is they've literally just opened up that market in the last couple of weeks for active ETFs. So again, to set the scene, on the left-hand side, the US ETF market is, on the left-hand side, the active asset management market in the US is still a significant chunk of the overall asset management or fund industry. So we hear a lot about passive, but I think the point is that actively managed mandates in the US are still a very significant chunk of the total market, as much as 3/4 of the total fund industry. On the right-hand side, though, what you can see is when it comes to ETFs, actively managed ETFs are a tiny percentage of the total ETF market. So you've got the situation where the US has not given up on actively managed mandates, as you can see on the left-hand side, but on the right-hand side, it's just not yet prevalent in the ETF market. And that's until now. So finally, the last couple of weeks, we've seen some issuers, as you can see on the right-hand side there. Fidelity, BlackRock, T. Rowe Price, American Century have started issuing actively managed ETFs in the US market, because the SEC, who's the regulator there, has approved those ETFs for the first time after waiting nearly a decade to do so. So Andres, do you want to give us your sense of what listeners should expect from the US active ETF market over the next few years?
Yeah, and it's important to remind the listener that actively managed ETFs in the US have been allowed and have been there for quite some time, but they just didn't gather assets. And my opinion, why they haven't gathered assets, because you don't have the big players in the market pushing this product. And put it this way, when you have Fidelity coming in, Goldman, JP Morgan, and many others, and Fidelity, which is on the screen, many others coming into the industry, which have a lot of expertise and experience in actively managed funds, and then you have all of their sales force pushing this product now, you should see quite a bit of growth in the US. What you had there before was the one-off active manager here and there that wasn't maybe as big as your T. Rowe Price, let's say, or your Fidelity in the US, right? So yes, they gathered assets, but not on a huge scale in the US. But now with these very large providers coming into the US, you're very likely to see this number, this 3.9% balloon really quickly. And just as an anecdote, when the regulators in Canada first looked at the market and said that the actively managed market was really small, so that's why they went with the rules that we have. The market was also 3%, and now we're 20%. So it's just been 5 years. So give it 5 years, and hopefully it'll be 20%.
Okay, well, I think let's, in the interest of time, let's take some questions. So maybe the first question here from George is, I think, relevant for the Australian market, where we've recently seen fixed income issuance. It hasn't really been a big feature of the market until the last maybe 12 months. You touched on it in Canada. What is it about the fixed income asset class category in Canada that has captured nearly half the active ETF assets?
It's the way we look at it is that it's just a harder asset class to manage. Let me put it into perspective from where we stand. So, for example, our TD has a wealth group, right? And we have a bunch of advisors at TD. And generally within our wealth groups, we have wealth management teams. And it's very easy to create a equity portfolio that you can give to all of our advisors and say, invest in this equity portfolio, right? But when it comes to fixed income, the view is that you need expertise in it. You need somebody who really knows what they're doing, especially in this environment when you have rates almost going negative and whatnot, right? And with obviously the credit market becoming more and more complicated in North America. So the view is that the advisor wants to give up this role to an active manager, and basically instead of spending a lot of time on actively managing a pool of bonds, they just give it to somebody else. The other reason is because it's much easier in Canada to trade the fixed income ETF in bulk versus to trade the single line bonds. So it's become very easy to make that switch from single line bonds to the ETF and just trade the ETF and manage your portfolio as a portfolio of ETFs. Got it.
And maybe a follow-on from that from Sally, who's obviously an advisor. She asks, I'm an advisor. You mentioned in Canada, advisors were the biggest users of active ETFs or investors in active ETFs. Why wouldn't an advisor choose a actively managed ETF instead of an actively managed mutual fund?
Yeah, it's similar to what I was saying. A lot of it is twofold. Lower costs, we did mention that. Generally speaking, it is lower cost if it's a new strategy. If it's the same strategy, in many cases it's similar. But one of the things that has really propelled ETFs in the fixed income side is the ease of execution. It's much easier for an advisor here in Canada, especially at TD, to manage a portfolio of fixed income ETFs than it is mutual funds. It's much easier to transact. It's far more nimble. And obviously, given that we have, these advisors in Canada have market makers, quite a bit of them, to help them out, it's very easy for them to do. So that's two main reasons why we've seen that transition from mutual funds to ETFs. Doesn't mean that those same advisors don't use mutual funds, but what we're seeing a lot of the advisors now in Canada do is many of them are moving to only ETF books. So they only do ETFs. They're much easier to trade, and it also really depends on your platform. Every bank will be different, to be fair, or every asset manager and wealth manager will be different. But in many of them, it's easier to trade ETFs, easier to hold ETFs. So we've seen quite a bit of growth there.
Okay, well, we probably have time for two more questions. One is from Stefan. He says, thanks for the presentation. In relation to the market makers in Canada and the US, are the market makers generally external parties to the manager, or does the manager itself act as the market maker for the fund, which is typically the way it works in Australia? The fund is the market maker, and the actual market maker is sort of acting as an agent for the fund.
Yeah, so as you mentioned, our model is different than the one of Australia. All of our market makers are external. They are all actually posting bids and ads. They're all basically the banks. You obviously have high frequency traders that are also making markets on those products. But for the most part, it's the banks. When it comes to actively managed ETFs, I would say the majority are the banks, because we're doing it for our advisors for the most part, and we want to make sure we're involved. But you do have market making shops that are not part of the bank conglomerates, also making markets in actively managed ETFs and ETFs in general.
Understood. Okay, and then the final one, which is topical in the Australian market, you may not have heard of this, is one of the managers here has just last week issued a fund. It's an Australian equity fund, which has an unlisted asset class, and the same fund can be traded on exchange. So it's sort of one trust or one fund and investors can choose whether they want to access that fund in the unlisted version, like a mutual fund, or we call them managed funds, or whether they want to buy or sell that same fund on exchange. So it's not a separate ETF of the same strategy. It's sort of one fund with different ways in which you can come in or out of that fund. Have you seen that in Canada much? And if so, has it been successful?
Yeah, and I actually alluded to this earlier in my conversation. So yeah, we see this quite a bit in Canada. So when I mentioned that you have an ETF class of an existing fund, that's what I meant. So we have this quite a bit. There's many players in Canada that have exactly that. That will have one fund that will be offering mutual fund form and will also be offering ETF class. So they both are basically looking at the same pool of funds, but they're offered under different vehicles. Has it been successful? Yeah, for sure. There's a slow transition of many managers into that format. Not everybody is set up this way. Many will have, let's say, the same fund separated, right? Like, they offer the same fund, but in different, they're not actually the same pool of funds, but many now are actually integrating them. There's reasons why people like them separate, and some of them are somewhat selfish in that the mutual fund can buy the ETF. That way the ETF looks bigger and it's somewhat like double counting. Once you pull them, obviously you can't necessarily do that. But we are seeing that reversal of the trend where you can both the mutual fund and the ETF live under the same pool of assets.
Great. All right. Thank you, Andres. I think we should wrap it up there. Thanks, everyone. I see everyone pretty much stayed on till the end. So sorry we went over time a little bit, but hopefully you found that very useful. My summary would be Canada, is the leading example of the active ETF industry globally. They have a very similar sized fund industry to Australia, yet their active ETF industry is 10 times the size of ours in Australia. So I think that's a good signal for what the future might hold in Australia. And in the US, they've literally just in the last few weeks started their active ETF journey. And so hopefully as that market, which is the biggest market globally, starts to light up the sort of media and education of what active ETFs actually are, hopefully that spills over into other markets like Australia. Just as a reminder, if you do want CPD points from this webinar, we are offering CPD points and we will send that to you after this webinar. And the replay of this webinar will be available. We'll put it up on Livewire and we'll also put it up on the Pinnacle Facebook and LinkedIn pages. So again, thanks, Andres, for your time today, and thanks, listeners, for your time and interest.